All right, we're back again with another report from Biztech Asia, where we'll show you a clip of discussion between host Brian Fernandez with guest David, co-founder of the Smart Investor Singapore on Asian Midday Market Watch, where he will share insights on regional markets performance as well as other key issues dominating investor conversations today. Let's take a look.
Now, David, but the big news overnight is the Federal Reserve's commitment to higher interest rates and tackling inflation. Now, what are those what's the story? What's your view on it, and what are the implications for investors?
Well, I think there are two takes from that, Brian. I mean, the first one is when you have a look at the American stock market yesterday, the S&P, the Dow Jones Industrial, and also NASDAQ were all higher yesterday, despite what the Federal Reserve had said. So either those people didn't believe what the Fed was saying, or they can't read and they don't really understand what the Fed was saying. But for me, it's actually quite clear. The Federal Reserve is going to carry on increasing interest rates and not only increasing interest rates, but they're not going to be cutting interest rates at all in 2023. None of the members of the rate setting committee said they were going to cut interest rates. So where these analysts come out and sort of say that there is a likelihood that the Fed will pivot, the Fed will somehow cut interest rates, I don't know where that story is coming from, because Jay Powell was very clear. He said that he is not going to be doing anything with interest rates apart from raising them until he sees some sign that inflation is going to be heading towards his 2%. And right now there is a gulf between where inflation is and the 2% target that he's aiming for. So I think people can forget totally about any kind of possibility of rate cuts in 2023, Brian.
Okay, so which brings the broader question around the global economy and whether or not the US economy and the global economy is heading for a hard landing or a soft landing, because the numbers just out overnight at Salesforce and at Amazon tell us a different story. They're preparing for a downturn.
Well, they are preparing for a downturn. In the case of Salesforce, they're going to be cutting 10% of its workforce. So 700 jobs are going to go at Salesforce. And then over at Amazon, probably around just under 1% of its workforce. It employs about 1.5 million people. So they'll be cutting 18,000 jobs at Amazon. So I guess these two companies are preparing for an economic downturn, or the possibility that sales are not going to be as strong as some people had been expecting. And in the case of Amazon, let's not forget that Amazon was around during the dot-com bubble. So it knows how to handle these kind of situations. And what it did was to employ a lot more people than it really required just before Christmas. And then now it's saying that it really doesn't need these people. So it's going to be axing 18,000 jobs. It's really terrible for these workers to suddenly be handed notices and be told that they don't need to come into work anymore. But as far as the Fed is concerned, that is probably what it really wants to see. It wants to see the labor market loosening up a little, because at the moment the labor market is still fairly tight, which is why a lot of the workers are able to ask for higher salaries. And the Fed doesn't really want that, because it knows that as soon as workers start asking for higher salaries, that is going to get baked into the cost of the company. And then the company has to pass that cost on to people like you and me, consumers. And when that happens, then there is no end to inflation. So maybe, the Federal Reserve quietly will be saying, oh, thank goodness, something is finally happening as far as the industrial world is concerned.